Hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. It's a Tuesday morning and the cues are fairly mixed. When you look at Wall Street, ended in the mixed zone. Asian markets are largely higher, but the GIFT Nifty hinting at a start above, that 22,500 mark. Once again, we'll have to see whether or not we manage to hit a fresh high today as well, given the fact that yesterday we hit a fresh high of 22,530 or thereabouts in intraday trade. However, we, failed to defend that 22,500 mark, which, by the way, will be a crucial level to watch out for this week. Of course, we have the RBI policy as well. So whether or not we manage to defend that level in this, data-heavy week is something that we'll have to watch out for. Lots of stocks in focus, including the likes of Reliance Industries. You have Aditya Birla Fashion as well. We could react to some bit of news flow. We'll be talking about that. We'll be talking about, all your stock-related queries as well with our technical expert on the show. So if you have any queries, keep them coming in on our live feed on YouTube. We will try and take them up as usual. But before we move any further, let's take a look at the top headlines at this hour. Wall Street kicks off second quarter on a subdued note. The Dow Jones and S&P 500 end with losses as US manufacturing data casts doubt on the possibility of a June rate cut. Rising treasury yields also exerts pressure on equities. Asian markets trade largely higher despite a mixed handover from Wall Street. The GIFT Nifty, is hinting at a fresh high around that 22,550 mark or thereabouts. Crude rises with the Brent trading above $87 a barrel on geopolitical concerns after Israel conducts airstrikes on the Iranian embassy in Damascus. Gold, meanwhile, continues its record run, trading above that $22.50 an ounce mark on safe haven demand. Among stocks in news, Moto sees sales decline even as exports grow by 87%. Ashok Leyland's March sales is down 4% on a year-on-year basis, but TVS Motors posts a 12% growth. Also in focus will be Reliance Industries as Jio cements its lead over Airtel as it adds more 4G and 5G subscribers compared to its rival. All right, let's take a look at the cues for today's trade, given the fact that, of course, as I mentioned, the Nifty hit a fresh high yesterday, but ended below that 22,500 mark. It still managed to clock in a triple-digit gain, 135 points up at 22,462. That was the last close for you. But important to see what the India VIX did yesterday. It cooled off quite substantially, ended lower by nearly 6% at around the 12.1 level. But, the talking point is really the broader end of the markets, given the fact that, the Nifty small cap index outperformed the benchmark indices and even the mid cap index, so to say. The small cap index rallied 3%. In fact, both the Nifty mid and small cap indices have been clocking in a string of gains since last week. Is the correction in the broader markets really over? Well, we'll be talking about this with our fundamental expert who will be joining in shortly. But looking at the FNO, cues, the Nifty open interest was down 7.2%, shed somewhere around 7.7 lakh shares. The Nifty Bank open interest was down 41.5%, in fact, shed 13.5 lakh shares. For the option cues, the Nifty put call ratio is at 1.07 vis-a-vis 1.18. No stocks, in the FNO ban today. Z has exited or has come out of the FNO ban. Looking at the fund flow picture, FIIs, of course, have net sold shares worth 520 crore rupees in the cash market, but DIIs continue to emerge as net buyers. 1,200 crore worth of stocks bought in the cash market. So all in all, that's the overall picture ahead of the market open. We'll just have about 9 minutes to go for market open. But let me also bring on board our technical expert for today. Joining me is Nirav Chheda, who's the Assistant Vice President, Equity Derivatives and Technical Research Retail at Nirmal Bang. Great to have you on the show, Nirav. Looking at the setup, 22,500 looks like, a very crucial level to watch out for. But would you expect a new high in today's session and also the Bank Nifty? Do you think that is poised to retest levels of 48,000 or thereabouts in the coming weeks?
Yes. Hi, Nandita. Good morning. See, in case of Nifty, Bank Nifty, the good part is after a sharp decline, the reversal has been in place and Nifty is near its all-time highs. it is on the verge of a breakout. So definitely, we expect Nifty to move up higher. No doubt, today there is a likelihood that we'll open a little gap down, but 20 to 500 is one level where we do expect, some resistance to come in. So once we, set off above the 20 to 500 levels for Nifty, you will see good buying coming in, and Nifty can go up towards the 23,000 levels. Now, what will be the catalyst, as you said, for Bank Nifty? I believe the Bank Nifty and the metals pack will be the catalyst for Nifty to break that 20 to 500 levels. Bank Nifty hasn't moved above its all-time highs, whereas Nifty has already done that in the last month. So Bank Nifty is somewhere, now very close to breaking those all-time highs around 48,500 odd. Importantly, the rollovers for the banks have been very positive, and we expect, these banks to now push the index higher, and in terms of Nifty as well higher. So definitely, the larger cap Bank Nifty stocks like SBI, IndusInd, Axis, ICICI Bank, these stocks, even Kotak Bank, these stocks have very low open interest. That means shorts have not been rolled over, which is a very good sign for these stocks. So definitely, I expect these stocks to move up from here. So there's one index that you can buy at the opening today, and that is Bank Nifty, and you can buy the futures on the opening. I believe it can probably open around that 47,800 odd levels. So first 5 minutes, just look at the moves, and then probably you can look to buy this index with a stop loss of around 47,600. I expect 48,500 to break very soon in this index. It can give you very good returns.
All right, watch out for levels of 47,800 on the Nifty Bank Index. But since we are talking about banks, I want to get in your thoughts on smaller banks like CSB Bank and South Indian Bank. Both have come out with their business updates, right? For deposits for CSB Bank, good 20% kind of an uptick on a YY basis. Even advances, for that matter, is up 18%. And if you look at South Indian Bank here as well, the deposits have been, in double digits, 11.2% growth on a YY basis, and advances also, similar picture here, 11.5% uptick on a YY basis. These two banks, CSB banks and Bank and South Indian Bank, how are you viewing them on the charts now?
Yep, both of them have very similar charts. So, for CSB, there has been a multi-year breakout above that 360 odd levels, and post that, 430, 435 levels that come in. The stock again came down to retest the breakout, and now it is now, heading higher as well. So definitely, I believe even this stock can move up quite higher. If not, at 480, at least it will retest its highs at 430. So that can be a good 20-25% from current levels as well. So one can look to buy the stock at current levels with a stop loss of about 345. South Bank, again, a multi-year breakout, post 2014. This is the first time the stock actually went up above that 30 odd levels, and, sorry, 28 odd levels. And then I definitely believe, the volumes have been very good in this stock. So something that is missing in CSB is the volumes. Volumes have been average, but for South Indian Bank, the volumes have been terrific. So definitely, this is one stock which I would probably buy from a medium-term perspective. I believe a huge rally is in the offing for this particular stock, and you can probably see this stock actually, becoming 2x. So yeah, from current levels, look to buy this stock. You can keep a stop loss of around 25 for your longs. And from a medium term perspective, I believe 40, 45 is the target that can come in. From a near term, if you're a near term player, 35 is definitely coming in.
All right, bullish view coming in there on a South Indian bank. Of course, the stock could double from here. That's the view. But another stock, I want to discuss before the market open and before I come to your picks. Aditya Birla Fashion, it has proposed the demerger of Madura Fashion and Lifestyle into a separate listed firm, and this proposed demerger will enable creation of two separately listed companies, and it is a strategic move that is aimed at enhancing shareholder value. The demerger will be implemented through NCLT scheme of arrangement once, of course, the approval is in place, and shareholders will have identical shareholding in the newly formed entity as well. Looking at the charts, I think in the last 5 days or so, it has done fairly okay. But of course, the stock is expected to react to this particular news flow. What are the levels you'll be watching out for here on the upside, given the fact that it is not very far from its 52-week highs now?
I mean, Aditya Birla Fashion, you're talking about ABFRL, right? So, Nandita, you're talking about ABFRL?
That's correct, Nirav. That's correct. ABFRL.
So, see, this stock, actually, this is in a downtrend. So, it's actually nearest 52-week lows now. And we expect, looking at this stock, don't expect much of an upside at current levels. The only thing going for this stock is the volumes, but this is not a chart where you look to buy a particular stock. Probably near term, this stock can do 230, 235, but I'm not really comfortable buying this stock looking at the pattern that it is going in. It's in a low top, lower bottom formation, which is a negative pattern. So, if it comes to 230, probably I'd look to sell this stock. Also, the rollovers have been very, very high for this particular stock. And that means, the high open interest means liquidation has to come in at some point. And that is also a slight negative for this particular stock. So I'd avoid this stock, from a buying list.
All right, that's the call on Aditya Birla Fashion. But, before we, come to market open, I want to get in your thoughts on what kind of an F&O strategy should one look at for the next couple of sessions, and what would you be keeping on your radar in terms of stock recommendations?
Yeah, see, for me, a good F&O strategy at this point would be a good bull call spread for Bank Nifty. Bank Nifty spot around 47,600 odd. I'd like to long the 48,000 call and probably sell the 48,700 or 49,000 call. I expect 48,500 and above for Bank Nifty to come in very soon. So this can be a monthly kind of a bull call spread where you can get very good returns as and when Bank Nifty moves up. Looks like a low risk strategy at this point of time from a 5 to 7 day perspective. Also from a stock specific front, I believe couple of stocks. First is the metals pack. As I said, there are two sectors that I really like. First one is the metal sector and the banking sector. In metals, Tata Steel looks very good. This is one stock which has done tremendously well in the last couple of months. From 120 odd, it's gone to 160, and 2 yearly consolidation breakout. So yeah, look to buy this stock with a stop loss of 155 and target 180.
All right, those are the recommendations from Nirav. But look at the market. It has opened extremely flat, but with a negative bias. Of course, below that 22,450 mark. If you look at the advance decline ratio on the BSE, it's in favor of the advances at the current juncture. Let's look at some of the other indices then. The mid-cap index, I want to see what the mid-cap index is doing. Sensex also below that 74,000 mark. The mid-cap index has opened in the green, 0.3% kind of gains coming in there. Let's also see what the small-cap index is doing. The BSE small-cap index open, positive open, 0.3% or thereabouts. But want to see what the realty pack is doing today. Yesterday, of course, the realty pack rallied somewhere around 4%. Let's see today whether it's continuing its momentum or it has come under a bit of a selling pressure. Realty index, of course, extending gains from yesterday. We saw the Nifty Bank index on your screens open with a negative bias, but also pull up the metals pack. Let's see what that's doing. Yesterday metals was the second best performer in terms of sectors. Today it is extremely flat, just about 0.1% lower. So all in all, it is a subdued open, so to say, but mid and small cap indices are outperforming the benchmarks at the current juncture. But let's take a look at some of the gainers on the index. Adani Ports continues its run. Top Nifty gainer, 2.5% gains coming in there. Bajaj Auto, 2% uptick. NTPC, BPCL, ONGC. So some of these PSU companies or PSU stocks continuing to do well. Nestle from the FMCG pack is also among one of the gainers. Tata Motors, yesterday autos were out of favor as the auto sales figures were trickling in. Today, Tata Motors is in the green, and so is Titan, which, by the way, was among the top Nifty losers yesterday. Bharti Airtel, Coal India are some of the other movers on the index. On the flip side, Wipro, top loser on the index. ICICI Bank, UPL, Cipla, JSW Steel, which of course was the top Nifty gainer yesterday, has come under some bit of selling pressure. Hero Moto continues to be in the red. M&M, Hindalco, some of the metal names under pressure today. But on that note, let's introduce our fundamental guest for today. Joining me is Kunj Bansal, who's from National Institute of Securities Market. Great to have you on the show, Kunj. Want to get in your thoughts on where the markets are headed in FY25. FY24, of course, we saw a phenomenal run, 30% kind of gains on the index. But would you say that it would be unrealistic to think that FY25 could replicate those kind of gains, and this time around in FY25 we need to temper our expectations? Would you say that would be the best thing to do now?
Yeah, so these are the questions which are always difficult to answer. And as you rightly said, we need to put some numbers in perspective which are already there. So for FY24, in terms of Nifty, almost close to 30% rise we saw. 29, 28, 29%. In fact, the higher rise was obviously seen in the small and mid cap indices, which moved up 60 to 70%. In terms of multiple valuations, if we look at so Nifty in general, broader expectation for FY24 to end is around 1,000 rupees Nifty EPS. Now at 22,400 odd Nifty, for the current year we are trading at 22.4. And if we take a 10% conservative growth from FY24 to 25 in terms of Nifty, which means we are trading at about 20 times Nifty, P ratio for the Nifty. Now, one can say whether it is overvalued, which is undervalued for an economy which is growing at the highest growth rate in the world. There will always be demand for stocks from its market. So to that extent, one cannot expect it to trade too cheap. And that's where probably one should look at it from the perspective that, okay, there is a growth rate at this end and there is a valuation at the other end. Now, what is the optimum combination? I don't think Indian market is something at this current GDP growth rate you will get extremely cheap, except for the incidences, specific incidences. So last we saw was at the time of COVID when we saw the really cheap market. Now, nothing of that sort has happened since then, and is not likely. Of course, these kind of instances don't tell you in advance that we are coming. They will come as and when suddenly. So yes, on a conservative expectation build-up for an investor would be and should be that to expect matured gains, a little bit of lesser gains compared to what we have already seen. But then one doesn't know. They look at the macroeconomic numbers of the Indian economy. We saw the GST number for the March 24 also coming in, has already shown 10% plus growth. For the full year, GST has continued to show good growth. Inflation has been in reasonable control. Let's keep in mind that FY25 would be a year of the interest rate correction. As long as all other things remain controlled, the inflation doesn't pop up its head, which doesn't look likely. So can that continue to that interest rate reduction? Can that continue to bring in more money into equities, both from global and domestic investors? And if yes, we could continue to see some returns coming in. So as I said, it will be difficult, but yes, expectations should be tempered.
All right, that's about the the overall market. But what about the broader end of the markets? When you look at the valuations there, the kind of gains we saw in FY24, 60 in excess of 60%, and of course there were warnings given out by the regulator as well, right? That there could be froth building up there. And since then, we've seen some bit of correction. But, if you see what the mid and small cap indices have been doing since last week, they have kind of snapped out of that losing streak, right? So would you call this an end to the broader market correction, or would you say that there is still some bit of froth left that should be coming off?
So again, difficult to predict such things, but again, let's look at a few things here. You are right that in the FY24 we have seen mid cap index going up 60% and small cap 70%, and a few other indices here and there, but broadly in that range. Now let's keep in mind that the indices get governed by those companies whose stock prices are going up. The weight of the companies whose stock prices are going down keeps reducing by default on its own. So what I'm trying to say is that what the indices reflect is that there are some companies which are continuing to do well in terms of the share price performance. The companies which are not doing well in terms of share price performance, their weight in the index is going down, and as a result, they are not able to have that much of an impact on respective index, whether it is small cap or mid cap. Now, obviously, if a company's share price is going up, then it means it has two things going for it. One, probably it's doing well fundamentally. And two, there is a demand for its shares. Now, demand for its shares will come, at least in the medium to long term, only if it's doing well fundamentally. In the short term, there can be many other factors such as market sentiment, such as liquidity squeeze, and things like that. Now, if that is the case, that if fundamentally some of the sectors and some of the companies continue to do well, we could continue to see such ups and downs in the short term based on various news flow, based on various triggers. But if, as I said, the companies which continue to do well will continue to keep the indices moving up. Of course, on a longer term or a medium term cycle of 3 to 5 years, if we take, we see this clear pattern of the difference in the valuation of mid and small cap indices merging with large cap and vice versa. So the gap goes up, then the gap comes down, then there is a merging of the valuation at one point of time, and then the valuation again diverges. So that is something that might continue. But as I said, the companies which will continue to do well because of the Indian market, because of its growth rate, is in a position of net inflows put together from domestic and global. The demand for such shares, such companies will be there, and as a result, those could continue to lead the indices up.
Let's also talk about various sectors that have been doing well. Realty, for one, among the best performers of FY24, and stocks like DLF have been hitting the roof. But here on, would you say that these stocks have limited room for upside? Also, the fact that pre-sales are expected to slow down here on. So, would the focus now shift to return on equity and other parameters? And what really would you do with some of the realty names now?
Yeah. Obviously, it may sound repetitive, but we need to kind of keep in mind that ultimately the stock price is a function of the fundamentals of the company and the valuation combination, which should be at an optimum level. That's one. Second thing is it's a function of the demand and supply in that respective stock or sector or the market. Now, as I said, Indian market is a market which is seeing net inflows on a net basis, taken global and domestic investors together. Global investors keep coming, keep going out, but that doesn't matter now with the kind of inflows that domestic investors have been putting in. Indian market is seeing net inflows. Obviously, a sector or a stock which has moved up sharply over a certain period of time. One is specific to real estate. Since you asked, we have seen that how the real estate market has done well in terms of demand almost all over India, specifically in the 6 or 7 metro cities that generally gets tracked at. In terms of volume sales, the volume of sales have been going up almost all throughout the year. 1 or 2 months here or there could have been negative, but on a year-on-year basis, we have seen the demand going up. That obviously resulted, or rather got reflected in the price performance of the real estate sector and in terms of the price performance of the companies in the real estate sector. As I said, once a sector moves up over a certain period of time, its valuation kind of tends to reach at a mature level, and then any fresh money coming in will try to look at the sectors which have not done well, as long as they are comfortable about their existing fundamentals or expected fundamentals, hoping to turn out well, and the valuation combination. So that's where we could see money moving out from the sectors which have moved up, like you said, real estate sector, to the other sectors which have not seen participation, as long as the investors see the results of their those sectors in the next few quarters likely to do well.
Of course, you mentioned that, some sectors, once the valuations mature, money tends to rotate into sectors that have underperformed. Would you say the same for PSUs? They have run up quite a bit. We've seen the, kind of returns we've seen from some of these stocks. So have valuations in the PSU basket also matured, and there's very limited room for upside from here? And should investors book profits or partial profits when it comes to PSU stocks?
So PSUs, yes, if we look at, in fact, PSUs in general have been now doing broadly well for at least 3.5 years kind of time frame across all the banking PSUs, which is one of the major sectors, and the non-banking PSUs, which are largely the manufacturing companies. Now that has happened obviously because at some point of time the realization came in the whole government machinery, the administration, even the managements and the ownership of public sector companies that our valuations are lower. Probably the investors are not comfortable with the kind of financial performance that we are seeing, and we have clearly seen financial performance of public sector companies going up. Again, largely led by the government policies of Make in India focus and giving more and more orders to, let's say, defense PSUs and domestic shipbuilding PSUs and all other electrical and electronic goods manufacturing PSUs, locomotive manufacturing PSUs, and things like that. So that's where we have seen. Now, in terms of valuation, although they, as I said, they have been moving up for 3 years, and their valuation compared to what it used to be at the low of the sector and compared to that what it is today has clearly gone up. But if we try and compare it to their private sector peers or to the general market valuation, they are still, I think, offer the scope for further movement from here, further valuation re-rating from here. Obviously, this is subject to their financial performance, which has significantly improved, continues to see that improvement. And that possibly is likely given the order buildup that is there, especially for the manufacturing PSUs, whose businesses are based on the order book. So in my view, there is still some space.
All right. But what according to you could be an overarching theme for FY25? When I talk about underperformers, would FMCG or can FMCG emerge as a dark horse? Because, of course, on one hand, there is, the forecast of heat wave in the months of April to June, right, which could see consumer durables like, AC makers and, beverage stocks do well. On the other hand, in the second half of the current year, there are expectations of El Nino, conditions switching to La Nina, which bodes well for, rural focused FMCG names as well. So do you think FMCG, which has largely underperformed till now, can emerge as a dark horse and be the overarching theme? Consumption rather could be an overarching theme for FY25.
So to arrive at an answer to that question, please allow me to move from top to down. Now, what I mean to say is, if I look at FY25, what are the 2, 3 major things that I am looking at or we are looking at in the market? One, as I said earlier, FY25 is likely to be the year of the interest rate reduction. Which obviously will be governed by, before that, the inflation coming in lower in terms of RBI expectations. I mean, RBI governs the interest rate, but in terms of general government expectations, investor expectations, and things like that. Now, if inflation comes down, let's keep in mind the reason for the slowdown in consumption. One of the main reasons, or rather probably the only reason, has been high inflation. If inflation comes down, we'll obviously see the consumption demand coming up, people getting back the ability to spend more and more. So that's one factor, as I said, in FY25, expectation of reduced inflation leading to lower interest rates. Now, lower interest rates will again leave some more disposable money in the hands of middle class who have borrowed money on loan, let's say for their houses or for their two-wheelers or for their other personal consumption. They will clearly see their EMIs coming down if the interest rates come down, and that will again leave some more money, disposable surplus in their hands, which will again come back to consumption. Before that, if I look at in terms of politics and social, also this is a year of the general election. Now, general election indeed will kind of results into more money coming into the system, because various government machineries have to work over time more and more, and a lot of money gets spent in the elections. Now, that also will result in kind of more money available in the system overall, available which will ultimately go to the people. Now, third thing is, what will be the composition of the new government and the policies. Now, that is an if. I don't have an answer which government will come to. The only thing I can think of is that the same government composition comes back to the power, we will have continuation of policies. Now, continuation of policies will be focus on the capital goods infrastructure, which has been the theme of this government over the its last two terms. Ultimately, that has a derived benefit, derived economic effect in terms of the other sectors getting benefited. So if I put all these two, three, four factors together, what we are not counting here for the shortage of time is how will the global inflow pan out over the years. So when we talk of interest rate reduction in Indian economy, let's keep in mind that it will be an interest rate reduction in global economies also, specifically the US. Now, could that lead to more inflows coming in into the Indian market? Possibly, yes. Now let's come back from there down to the market. So yes, market, that incremental money will look for sectors, as I said earlier, which have not participated, whose valuations are comfortable, and whose financial performance, given the lower inflation, lower interest rate, is likely to improve. So consumption in that will certainly be a sector to be watched out for, which will include across the consumption band. So it will be fast moving also, it will be consumer durables also. If you allow me, I'll possibly add automobile also, at least the two-wheeler part of it into the broader consumption space. So yes, that is something that needs to be watched out for.
All right, that was a very holistic answer on, which pockets to really watch out for in FY25. But very quickly, the earning season is upon us. We saw Accenture, cutting its guidance, and expectations are that for Infosys, the guidance will be in the range of 2 to 6%. So for IT companies, do you think the recovery could be delayed by a couple of more quarters? Because of course, the rate cut in the US looks unlikely in the month of June. I mean, the jury is still out there whether or not we'll see a rate cut in June or not. So, in that sense, do you think the recovery in IT stocks will be further delayed?
Yeah, so the June rate cut expectation in US market has now dropped below 50%. Earlier it was higher than 50%. So yes, that doesn't look likely. IT sector, if we look at the news flow, if we look at the performance, if we look at the management commentaries, etc., clearly is under a slowdown, and that is something that is likely to continue. Now, what happens is that at the same time, whether can be related directly to the factor that as a result will the sector continue to underperform is difficult to say, because Indian market, as I have been repeatedly saying, that is a market of the net inflows. Now, every incremental money at some point of time starts to look at the non-participating sectors or the sectors which on relative terms have become undervalued. Now, that's where we continue to see investors buying interest coming back again and again at some point of time in IT sector. But yes, in terms of the news flow and the signals that are there on fundamental analysis, we could continue to see some slowdown in the IT sector.
All right, that's the view on IT sector. We could see some more slowdown from here. But with that, Kunj, we're completely timed out. Thanks a lot for taking out time and joining in and sharing your thoughts with us. Look forward to having another chat with you sometime soon. Well, with that, let's go back to Nirav, who's been waiting by very patiently. Nirav, let's quickly take up all the viewer queries that are trickling in this morning. The first one is coming in from Saurav Ghosh, and he wants to know your thoughts on a Motherson, Samvardhana Motherson, right? The stock, it's trading with a positive bias today, almost 1% up, but it's just a whisker away from its 52-week highs. How should one trade into this?
See, at this point, it's in a consolidation. No doubt, there's been a good reversal for the stock from the lows of about 110 odd. But I believe it is now hitting its resistance area, which is around that 123, 125 mark. And I don't see it moving up quite significantly from here. So it would be a good idea to book some profits as it moves up toward that 123, 125 levels. Alternatively, you can keep a trading stop loss in this stock if you're already holding of about 119. The open interest is quite high for this stock, so don't see a big move coming in here.
All right, that's the view on Samvardhana Motherson. Hope that answers your query. The next one is coming in from Chirag. He wants to know your thoughts on a GNFC. No big bang moves when it comes to this stock. If you look at the monthly chart, the 6-month chart, but on a YTD basis, the stock has shed quite a bit, 20% almost. Here, if somebody has positions, what should they do?
Yeah, so see, this stock is moving in a higher top, higher bottom formation, and if you see, from 2023 March onward, from the lows of around 480 odd, this stock is moving up slowly and steadily. No doubt it made a high of 825 and it has come down quite significantly, but it has not broken its previous bottom. So higher top, higher bottom is still in place. And the reversal again is now still in place. A very good reversal is in place from 600 odd levels. Volumes as well are being seen now. Short covering is seen. I believe this stock can now move up toward that 750, 800 levels again, probably even break the highs and move higher. But from a short term perspective, you can look to buy the stock at current levels, average it if you have bought it at higher levels. You can keep a stop loss of around 620 for your longs, and your first target would be around 725, 750.
725, 750, that's the target, that Nirav is suggesting on this stock. But the next query that is coming in from Mohit Anand Bhatia. He has some queries from the metal pack, NALCO and NMDC. He wants to know whether these stocks are worth buying at current levels. Yesterday, of course, the entire metal pack was extremely buoyant. It was shining bright. But today, it's cooling off a bit. But after yesterday's rally, do you think these are, good levels to get into these stocks?
Oh, definitely. Nandita, if you ask me, one sector which will do very well in the next 6 months, I'll say metals. Why? Because, there has been the 2 year consolidation which has gone in most of these metal names. And then, we've seen some stocks moving above multi-year highs. So both these names, National Aluminium and NMDC, they are above their significant levels, which are around, for NMDC 150. In 2012, that level was seen, and after that, this is the first time this stock has closed above 150 on a weekly closing basis, and it has really moved up since. No doubt, from 250 odd, it has come down, but very good support has been taken around 200. I believe this stock is the one which can move up quite significantly from here. So 300 is coming. Look to buy this stock at current levels. Definitely invest in this. Your stop loss will be 200 for longs. Also, National Aluminium. Post 2008, this is the first time this stock has gone above that 130, 135 odd levels. And after that, volumes that were seen are terrific. Even in NMDC, volumes are terrific. So both these stocks, I really like. And what happens is generally when these multi-year highs are broken, the stocks don't settle for 15-20%. After a 10-year period, if a breakout is coming in, it will actually move up, at least 2x, 3x, because it has to actually, take that 10 years into consideration, that consolidation. And in the next 1 year, it will give the returns of the total 10 years. So I definitely believe this stock can move up. Both these stocks can move up quite significantly from here. Do invest in these stocks. They'll give you good returns.
All right, that's the view on the metal stocks. Outlook is pretty bright from here. That's what Nirav feels. But the next query on our feed is on SBI card. This one is coming in from Divik. I think SBI card is one stock that was stuck in a downtrend. At the current juncture, in the last 5 days as well, hasn't done all that well. And it largely has been stuck in a downtrend. On a YTD basis as well, it's down nearly 10%. Would you recommend this stock to anybody? Do you think it's worth a look, looking at it? Or should one exit the stock if they have positions here?
Clear downtrend in this stock, and the view is to exit. There are so many stocks which are moving up quite significantly. Probably, if the volumes are back in this counter, only then it will move up. But at this point, I can't see much volumes coming in as well. So, it is better to exit this counter, and put your money in the metals names that we've already discussed. It will be a better bet at this point.
Right. Very quickly, couple of more queries then. Rupak Mehta wants to know your thoughts on an HUL. I think he's been holding it for 2 years without, any upside. He wants to know if it is expected to see some bit of upside this year or not. How should, of course, FMCG stocks have been clear underperformers in this market. Do you think the trend will reverse here on?
Difficult to say, in this next 1 year if this will go up. So what really happened is this stock witnessed a multi-year bull run from 2004 onwards, when it was around 100. and that bull run ended somewhere around that 2021 period. So post that, a long consolidation is in the offing. So this consolidation generally lasts for 2 to 5 years, and 2 years have been completed, but this can still extend to another 3 years. So very difficult to say if this stock will actually move up this year. Yeah, from a long-term perspective, if you are looking at a 10-year period, you continue to buy every year. You will see a good move, after this consolidation. But I would probably avoid this stock, even for this year, because I'm seeing a lot of mid caps, small caps doing very well, and still have some space to catch up to the large caps. So I would be avoiding this counter.
All right, that's the view on an HUL. But last query really for today, Satvika Ranganathan wants to know your thoughts on a Suntech Realty. How are you viewing a Suntech Realty vis-a-vis the likes of DLF, Oberoi Realty? Do you think, the other names that I mentioned are better compared to Suntech?
Yes. See, Oberoi and DLF have seen multi-year breakouts, and they are well placed to move up another 20-25% from current levels. For Suntech, it is still in consolidation. The upper band is around 540, and lower band, somewhere around that 300 levels. It is stuck there. So, from a near-term perspective, if you want to buy, there is a slight reversal chance up to 500 odd levels from current levels. So that's again 15-20% from current levels, but I don't see a big move coming in post that. So yeah, if you want to do a near-term trade, then you can buy Suntech with a stop loss of 410 for that target of around 500. But don't look to hold this stock from a 6 to 8 month perspective.
All right, that's the view on a Suntech Realty. Hope that answers your query. But with that, Nirav, I want to take this opportunity to thank you for taking out time and joining in this morning and sharing your thoughts with us. Look forward to connecting once again sometime soon. Well, with that, we've come to the end of this edition of Opening Bell. But just as we leave you, markets have turned into the green, although they are, quite flat at this juncture. But heading towards the 22,500 mark, which I mentioned at the start of the show, would be an important level to watch out for. Mid and small caps continue to outperform the benchmarks. The mid cap index is up by 0.5% or thereabouts. So all in all, the texture of the market looking pretty good. The Sensex, in fact, has edged back above that 74,000 level. But with that completely timed out on this edition of Opening Bell, thanks a lot for tuning in. Have a good trading day, and of course, come back and join us on Closing Bell at 3:30 p.m. Goodbye from me and the entire team. Thanks a lot for watching.